Okay, folks, welcome back. This is our weekend review for the ICT mentorship for May 1st, 2020. All right, so we're looking at the dollar index as our daily chart. And on Thursday and Friday, we had both days deliver a run below the short-term low. Here were our sell-side liquidity pool. I have my little eyeball sitting here. That's where I was wanting you to focus. Let's remove that now. Actually, let's go back and put that back on here. I'll just move it on over here now. So we're looking for it to go next below this sell side liquidity pool. And again, if we want to see it gain momentum and reach inside this BISI, all right, so the first objective below the sell side liquidity pool would be the 97.35 level, and then consequent encroachment, which is the midpoint between this level and this level, and then ultimately it could, if it can get really animated on the downside, the 96.70 level. I'm going to hold off with that as an objective right now. I just want to see if we can continue and move into a deeper run on the sell side liquidity pool here. And if we do get below that momentum gains, then our attention goes right to here, this BISI. So this particular candle's low. That's the next point of reference for IPTA. All right, so it was very nice to see this deliver as we outlined on Wednesday, and we want to go into a lower time frame hourly chart. All right, so here's the hourly chart, and I kind of want to move through this video rather quickly, so I'm not going to give you a lot of commentary, not jawboning about the COVID-19 and all that business. All right, so here's the hourly chart for the dollar index, and the red line is that old low on the daily chart. That's where I had my icon, the little eyeball, drawing your attention that that's where we would be looking for it to trade to, and that was back here on Wednesday. So we were looking for it to trade down through and reach for the liquidity. Now notice on this candle here, we dropped down into it with a very, very shallow run. The low is 98.81. The level that we had mapped out was 98.82. So it only went down 1 point or 1 pip below the level we're looking for. That is always a shallow run by definition. So what this does is it's kind of like a dead cat bounce. Even if it runs back up, say it was to rebalance here, go back to the bearish order block. Every time I see this, okay, if my bearish bias is intact, and that would still be there if it came back up to here or the order block, if it does that, my experience has taught me that this is going to be a deeper run at a later time. How much later is going to be determined by the price structure that's in play and how many days left in the week. And this was Thursday's low, so that means there's probably going to be a strong likelihood that Friday will make a more meaningful run through that low, and we see that happen here. Now it's going to sound like, okay, for some of you new in this mentorship, it's going to sound like, well, you're only saying it because it actually happened. Trust me, okay? The things I'm giving you in the commentary are general rules that I live by, and how I'm able to call the moves when I'm opinionated about it. When I say one side of the marketplace is over the other, in other words, I'm bullish and I think it's going to go to one particular level higher than where the market is at the time I'm doing the recording, I'm telling you that I feel confident about it. There's going to be times where I'm not confident, but when I am confident, what lends to that analysis and pushes me into that frame of thought is the things like I'm talking about now. So if we know we're bearish, we were bearish on the dollar on Wednesday when we met, and this Thursday run here, it did go below our level. It did hit it and go below it, yes. But this, by 1 pip, is not what we are expecting to see, especially if we're bearish. We want to see the market make an attempt to really get down below that low. Okay, so notice what they did here. We have a low here and low here, both of which are too shallow. So this little rally back up in here offset the buy stops that were here, and then it made an aggressive run lower. So we want to see this continue, kind of like what we saw here, may do this similar thing here and reach down into the next objective. And we will see if it needs to get any more retracement from here on the higher end. I don't think it needs to. I think it just needs to stay heavy meaning that the price should just continuously drop. Now, it doesn't mean that there's going to be, 100 pip moves each candle. That's not what I'm trying to build in terms of your expectation. What I'm trying to tell you is we're staying with this bias. We're looking for the dollar to weaken and to the levels that I've outlined in the daily chart. So when we look at price, and when you're watching, if you have the ability to watch it live or go back into it hindsight, you want to be looking for, did it go into a fair value gap? Did it trade back above an old short-term high to take stops? If it did, then it means it's live or go back into it hindsight. You want to be looking for, did it go into a fair value gap? Did it trade back above an old short-term high to take stops? If it did, then it means it's free to move with speed and a lot of magnitude because it's offset any buy-side liquidity and paired it up with new shorts. And then the IPTA will accelerate down. Otherwise, if it hasn't run any stops or buy stops, if it doesn't do that, then it's just going to be a steady drift lower, and then at a later time it'll run some short-term high for stops, and then a level of acceleration will happen. But either side of that equation still leads to lower prices in our expectation. All right, so here's the 15-minute chart. Look at these levels right in here. Okay, 1, 2, 3. You want to see these as price forms them, just like it did it here. Okay, just like it did it here. Run the buy stops, drop lower. Equal highs, run the buy stops, lower, retrace back to fair value gap, small little one in here. Drops down, runs the sell side liquidity here, leaves this intact as it retraces again, fair value gap, bearish order block right there, and then it runs below these and this low here, but it's shallow. Now what happens? What did I just say in regards to price action when we're bearish? And the same thing is said in opposite terms when we're bullish, but if we're bearish, we want to see price run some buy stops. Okay, if we see the market run above equal highs like it does here, and we've only done shallow runs below previous short-term lows where sell side liquidity is, stops are not just right underneath these old lows. They're a little bit layered. Okay, so every point of reference I give you in my analysis, if I'm calling out a specific level, now I'm trying to choose my words very carefully because many times I say things and people do not listen to the context of which I'm saying, and they run away with some misunderstanding, and then it just snowballs into more confusion or just creates a problem for me to fix at a later time because they have built this idea around a misunderstanding. My entries are very specific. It's not a zone. Okay, my entry points are very specific price levels. But when we're seeking liquidity for like targets, running above old highs or below old lows, there's layered liquidity, and you'll actually hear me talk about that in specific teachings in the mentorship. But I don't know exactly where they are, so please don't email me, Mark. Okay, there's lessons that are really just scattered all throughout the mentorship that talk about liquidity, and like this level here, that particular blue line, below that line is going to be stops in a layered fashion. Now, I'm not claiming to know what exact levels are being used for stops. It's not important to me. I just know the general rule of thumb is below these lows and this low here, it's going to be a lot of different levels that would be used for sell stops, okay, or those individuals looking to get short below these levels. So there's a lot of discussion about liquidity, which we're not going to cover here, but is talked about in many lessons throughout the mentorship. But whenever we see equal highs, we like to see that. We welcome that. We want to see it happen. And then we see a Judas swing. Judas swing is here. A Judas swing is here and here. All right. And it's running above short-term highs. Now, why is it doing that? It's gathering liquidity to pair up those individuals that understand what's about to happen in price. Who are those people? Well, it's you now because you're a student of mine. A bit before that, it's the individuals that are on the banking level, and it's not the bank traders that you may hear about saying, oh, well, let me talk to a previous bank trader or a previous banker. Those guys don't know what you're learning. And that's what's incredible about this. You are learning a different type of understanding and different level of analysis, because this is not what, like if you go to a bank, okay, say you go with the UBS, okay, and someone takes you in and you start working there. They don't sit you down and teach you IPTA. They don't teach you this, okay? What you're learning is the intricacies that create the underpinnings of the marketplace. So what creates movement in price? How does it move to a specific level and then generate a lot of energy? That's what I'm showing you here. So we have a bias, and it's been bearish. Okay, Wednesday when we met in video, we were looking for lower prices on the dollar to run below this particular level here at 98.82. So we wanted to see 98.80 and then lower. We want to see it go through that. We don't want to see it go to this red line and reverse. We don't want to see it go down below that and reverse. We want to see it go through it. So how do we know we have a strong likelihood of that occurring? If we see equal highs on a Thursday get rated here, they run up to get everybody thinking it's created a low. And then the aggressive sell. It runs down, but only to a shallow run below that low from the daily chart we've outlined here in this red line. Then there's a retracement, consolidation, drifts lower, equal highs, runs above it, drops down. What's it doing? It's running deeper than this low here. Then it retraces to do what? These relative equal highs. Remember, look at the context of what I'm saying here. The low has only been ran shallowly. Okay? It doesn't even sound like a word, shallowly. It runs very shallow below the previous attempt to get below that red line that we've outlined from the daily chart. So if it's done at shallow and it's retracing, even if you get stopped out, this is one of those instances where you can say, okay, this is still an underlying bias that has not changed, because we now have equal lows, this low and this low, with the context that we're bearish and we want to see it trade lower from the perspective of the daily chart. So when it runs above this short-term high, you may be stopped out if this was a pair that you were trading, but it's the dollar index, so it's our barometer for directional bias. These relative equal highs, if they run above that, then your assumption should be, okay, it's going back above there to get more buy stops or buyers willing to buy at a higher price that we as smart money analysts can use for liquidity to counterparty with a short position. And then once it takes that liquidity that's resting above these equal highs here, or relative equal highs, that layer of orders that resides above that, this high here, and I'll just put a little line here so you can see it graphically. All right, so you can see above these highs, look what it does. It stays up there, gives the traders that understand what's going on time to put their positions on. Then price drops. It's not that, oh, we ran out of buyers and now the sellers come into the marketplace. That's not what this is, okay? This is the market being manipulated and held there to allow bears on the dollar to accumulate short positions. Then price is allowed to drop. It's not buyers, buyers, buyers. Okay, we ran out of buyers. Now it's only sellers. That is the dumbest thing. And there's a lot of highly respected people in the trading industry that say that type of thing. That is not what happens. Okay, these markets are absolutely controlled. They're controlled by price and they're controlled by time. Period. End of story. It's over. There are times when very briefly and very intermittently human involvement will be involved with moving the marketplace or generating a repricing higher or lower. But most of the time, It's artificially controlled because of an algorithm. All right. Once you understand that that's what you're dealing with, and you look for the signatures that I'm teaching you here, it's undeniable. You'll see it, and you'll understand the mechanisms that's taking place, because they don't change. They're not morphing into something different all the time. It's always the same things, just done slightly different, but you know what they are when they're happening. And what do I mean by that before I go into Euro? The idea that if we're bearish, we're assuming the market's going to go lower. What we're looking for is buy stops to be rated for speed when it drops, or just a steady drift lower if it's going back to a retracement to a fair value gap or a bearish order block. That's the difference. Okay. And when I'm talking about, like, you've watched videos where I'm trading and you see me doing executions, a lot of times you can see it in my YouTube channel. I still have some of those trades still up. You can actually see me trading the market, putting my order in, and then I'm annotating the chart as it's happening. Before the actual market starts moving, you see me doing certain things in the chart, and I'll say, now I'm expecting speed and magnitude, okay, and distance. When I say those things, what I've actually tipped off to you in this teaching here is I've seen stops be rated, and now they've booked a large bank of orders for it to be profitable for them now to allow markets to go in the direction I've outlined. In other words, basically what I just said in regards to these highs here, if we're bearish, we really like to see those highs be taken out, because we know once this occurs, that's when speed enters the marketplace. Speed and magnitude. So as a short-term trader or as a day trader, that's the secret recipe for when the moves are going to be very, very powerful, very, very short, just quick runs to liquidity. That's the little secret recipe. That's the little signature. That's the blue ribbon result of looking for the stop run. But it has to be coupled with a bias, and it has to be also coupled with the idea that you're targeting a specific level of liquidity where another opposing side of liquidity would be. And what do I mean by that? Below this red line was sell side liquidity, as I outlined on Wednesday. Anything above short-term highs or a single high constitutes as what? Buy side liquidity. So from a market efficiency paradigm standpoint, as I teach, we're looking for buyers at a higher level to sell to, and we're looking for sellers at a lower level that want to sell to us that we can buy and cover our short, or go long running their sell stops, and then reversing the scenario, looking for buyers at a higher price to sell to exit our position. Whereas when you come into this industry as traders and you're groomed through books that teach nonsense, all this retail nonsense, support and resistance stuff, see, they think by teaching you, okay, there's an old high and an old low, and when it goes there, it should act accordingly. Okay, well, here's a low, and it bounced. Price comes down to it here. Why didn't it go up? Because order flow is bearish. So you have to change your way of thinking and not just think, well, let me find an old high. If it touches that, I'm going to sell short. No. You have to be bearish on a marketplace and then look for an old high or equal highs relative, and then wait for it to go above those highs, which breaks the whole theory of support and resistance, or in this case, retail resistance. So that's one of the things that I used when I saw the book Street Smarts, and I can already hear you saying, you said you wasn't going to give me a lot of commentary. I can't help it. Okay, I'm ICT. It's just I got a mouth. Okay, I like to talk a lot. So with that book Street Smarts, when it talked about that pattern of turtle soup and turtle soup plus one, I think it's what they also. I don't teach that here. Okay, I don't like the idea of the rules, because it's just overcomplicating the very simple premise that, okay, just sell short above an old high when you're bearish. That's what I got from that. But you don't get that from that book. So that's the gleaning I got from that, to go into the charts and start saying, is there really something to that? And then it started, one more little piece of the puzzle came together. So I'm not when I say turtle soup, it just caught on because I talked about that book when I was over on Baby Pips. A lot of people ask, what books do you like? I promoted that book, and I still think it's something that you should have in your library. But that book, if you look at what I teach, I don't give you those rules. Okay, that's not what's here. The idea, the general premise behind that pattern, I loved it because it made such a huge impact on my understanding and my learning curve, because I didn't understand the runs to liquidity as well until I saw that pattern, and I went into it looking for it to fail, and I saw a lot of times failing, whereas it makes its case for it's a strong pattern because Richard Dennis, his pattern for Turtle Soup, not Turtle Soup, but the Turtle Traders, was to buy 20-day breakouts above and sell 20-day breakouts below, and then stay with that trend and get stopped out otherwise. And it catches huge moves, but it stops out a lot. So their delivery and marketing of that pattern Turtle Soup, while cute and in many ways it's applicable if you understand what you're doing in the marketplace. See, the turtles didn't have a real strong bias model. They didn't care. They just mathematically said, okay, what's the highest high in the last 20 days? What's the lowest low in the last 20 days? And if it goes above the highest high in the last 20 days, they're going to be kicked in long, and they're going to use a big stop loss and just let it go. And you'd be surprised that large funds have very similar ideas, but not to that elementary state. That's a very oversimplification, but oversimplification and good money management and following the same procedure over and over and over again made millions and millions and millions of dollars for those turtle traders. The pattern that's taught in Street Smarts, Turtle Soup and Turtle Soup Plus One, I don't like that pattern the way they present it, but the underlying context of what they're trying to capitalize on, while still not being really taught in the way I teach it here, because I give a lot of detail about that pattern and a lot of teachings. My approach to stop writings, not teaching or reteaching Turtle Soup. So again, all these people out there, when I give credit to the people that have lasting impressions on me and my development, they take that as, okay, see, he said that he learned from that person and all he did was change the name. Look, that's why I tell everybody, go to that book, read it, look what that pattern is, and then find anything remotely close to that in my teachings. It's a stop hunt. That's all it is. But everybody understands stop raids, stop hunts, them getting you. Okay. You have two camps. Those that believe there's a them out there getting you. Okay. Or they don't exist and you're just wrong. It's both. You're wrong because you put your stop raid, they can take it, and it's advantageous for them to run it there. Okay. So both camps are right, but both camps miss the underlying premise that I bridge that gap in this mentorship and my teachings, actually, and even my free level stuff was very influential for a lot of traders to see that thing that takes place. But anyway, the crux of this whole video today is when we have a bias, we want to see a stop run that would be opposing the view that I've kind of like pushed on you in terms of a bias. So bearish dollar, we really invite the idea of equal highs or a single high being taken out because we know why that's happening. The mechanism is the price engines are going up there to allow orders that will be resting above these equal highs to enter the marketplace and flood the marketplace with willing buyers. Now, when I was a trader coming up, it didn't make sense to me. Like, why would the market go up there to get buyers in? It didn't make any sense. The reason why it didn't make any sense to me is because I was looking at the market through the lens of support and resistance. My idea was, okay, it stopped here, stopped here, stopped here. So if it goes up to this point, it should stop because that's what resistance is. Okay? And it didn't work like that. And it's a whole paradigm shift when you start looking at what the market's going up for and when it's going down for. When it does it short and sweet, real snappy movements, and you have a bias that's opposed to that view, you know what you're going to see. That's a Judas swing. That's a sucker play. Okay, this is the Judas goat leading all the sheep into the slaughterhouse. Okay, and then whoop, it's going the other direction. Well, when we see that, and just like we see it here, study this in all of your charts, not just the dollar index here, but study in all time frames, all pairs, even look at it in stocks. Okay, and you'll quickly grow to appreciate the gold, the diamond insight that has been offered to you just in this teaching. And it sounds like, well, you've already talked about this before. No. Think about it. We have a bias. Okay, by itself, we're looking for lower prices. But when do real sharp, fast moves in that direction occur? When the stop raids take place on buy stops. Okay, but it has to happen with a very short, abrupt run to those buy stops. It can't be where it just hems and haws and look, just reaches up there. It makes a real sudden run for it. Now, when you're not versed in this, and I can tell you back when I was trading commodities, when I saw the bond market and the S&P market do this, I got tripped up a lot, and I second guessed myself a lot when I would see moves like this, when I was expecting bearishness and it would run up like this. I'm like, oh man, I'm wrong. And if it hadn't already stopped me out, I was just bailing on the trade. And then this would happen. I'd be like, what in the world's going on? And that was demoralizing. So that's a normal growth. Okay, that's a normal growing pain to go through. And if you've been trading with money, real money, before you should have, okay, you've experienced this. And you know exactly what I'm talking about. You know what it feels like. So to avoid that feeling, you want to stick with a bias, stay with it, until it's proven to you very clearly that the bias is no longer valid. Our bias is derived from the daily chart because 90% of the institutional order flow is linked to what's going on in that daily chart. Why? Why is that daily chart the most important one? Because that daily chart is the timing time frame for large fund traders. They're using a weekly chart for their bias, but we're using the daily chart to constitute a bias on a daily basis, an intraday basis, a short-term weekly basis, and it can be used for any type of trading that I teach you in this mentorship. So our focus always opens up with that daily chart. And if we can get a underlying directional bias, that where's the market going to reach for next? Well, that's what I do with you every single Wednesday and on the weekend. I show you where the market's going to reach for. By that alone, just that simple little thing right there, okay? But that's, I've seen other people on social media, they're doing 500 pips, Michael. This is not impressive. Oh, this 25 pips stuff, Michael, this is not impressive. Look, you can make as much as you want to make if you are consistently able to find pips. But you have to start somewhere. So when I'm talking in these mentorship commentaries, I'm teaching from a level of understanding that even the people in the first month coming in can get something from it and it not be too high and lofty in terms of theory. All right. So just in your notes, you want to make sure that you have, when we have a bias and it's bearish, if we have equal highs or a single high rated with a very short, quick run above it, that's a Judas swing. Expect that to be a reversal, and then sudden movement, large ranges, speed, and magnitude. That's this. Okay? That's this. But the combination of bias, opposing direction to run buy stops when it's bearish, and then targeting the speed and magnitude is going to occur until we get to a level of liquidity that we can clearly see and outline that you're taught in the mentorship. And you can see it running deeper here. Okay, but now since we broke that, we're not assuming that, okay, now we run below these equal lows, it's going to reverse and go the other direction. No, we're looking for a longer depreciation of the dollar to those lower levels I've outlined on the daily chart. Okay, so that's basically, I took you a long way around the barn just to basically say, we're looking for this to continue, but look for this type of event to occur as we make lower lows. Okay, so I'll just look for that type of that pattern. Otherwise, if it returns back to a bearish order block or comes into a fair value gap, the mechanism or the price engines at the central bank will tend to be a little bit more lackadaisical, just a little lazy in the way it delivers price, and it won't be such a hurry to get to those other levels of liquidity. In other words, it'll be more sustained, just a drift lower. All right, so here's the euro dollar. So their daily chart for euro, and as I outlined last week, I was giving you and the previous week before that, I said that if I was the market maker for euro dollar, and everyone knows I'm not, but I would have taken the market below these lows here to give everyone the opinion that this descending triangle was most likely unfolding and lower prices would be in order. To upset that sentiment, I said that I would take it lower than this low here and then rally it up to take this high out here. All right, so again, you have to go back and watch the last several videos. If you're new, you're probably just watching this one because you just joined up, but you go back into the archives and you'll see me actually talk about all these things beforehand. And if there's ever a question, if there's ever a question about the continuity, the consistency, the visibility that is shared here, you have the evidence of it in our archives. Okay, so the weekly commentaries will prove that there's a lot of visibility here, and I try to keep it very simple, not try to make it overcomplicated. Where it is I'm thinking it's going to go and why, and that's where I spend my time talking about the daily chart, doing that. And what that's doing is it's building and exercising your reticular activating system. I'm teaching you because you're here listening to me, and the people that don't do well here are the ones that try to arm wrestle me, okay, because they're trying to be egotistical, like a young man like I was. I want to be smarter than everybody else. Listen, I'm not wasting my time talking to you, okay? I'm telling you what almost 30 years of experience has given me. There are times I'm going to be wrong, and you're going to go back and see that there's very few times that that's like that. But when I'm unsure, I'm also honest, and I tell you I need more information. And it may not be what you want to hear on a Wednesday when we do our midweek review. It may not be what you want to hear on a weekend. Okay, you want to hear what's going to happen on next week. Sometimes I don't have the information to feel confident about where it's going to next. But then I'll tell you, this is what I think might be useful to me, okay, and you as a student, or this is a scenario that might happen. I'm not doing plan A, plan B, and then whichever one happens, I'm right. That's not what I do here. If I'm opinionated about something, I will tell you, this is what I believe in. This is what I think is going to happen. That's what I say I'm 98% of the time right about. If you add up all the other times where I do, this is what could happen, anybody is wishy-washy then. But when you go back through all of my archives and you hear me say, this is where I think is going to happen, blah, 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 and you do that from the time it started, it's very, very consistent. And again, it's not ego, it's not chest pounding. It's just to reassure you that you are in good hands. I didn't just start doing this. Okay, I've been doing it for a long time. And you'll also see that the things that I do in the commentaries are repeating all the time. It's the same model, it's the same premise, it's the same approach. I'm not giving you a curveball. It's the same thing that I'm using all the time to build a bias. That's all you need. All you need to know is what's going to happen most likely tomorrow. And will it have the potential to continue the day after? That's it. Because 20 to 30 pips a week, if you can do that consistently, you don't need a job, period. And I don't care how much money you have. You don't need a lot. Okay? If you can consistently carve out those number of pips and understand risk, you can change the entire history of your family tree from you going forward. And that's very exciting. That's exciting. And that's the kind of framework that I want to impress upon everyone here. Not just think, I want to get rich. No, change your entire family history. Okay? Change your family tree. Prune all of the bad stuff that everyone is brought out into this world thinking it's hardship. It's hardship. And yeah, it's hard. But you are learning a skill set here that will remove many hardships if you give it the chance. And that means be patient. Give yourself the time to learn. Don't fast track through these videos and try to gorge yourself, because you won't retain it. It's too much. It's absolutely too much. Okay. So anyway, remember I wasn't going to do a whole lot of commentary. I can't help it. So anyway, the market went below the low here and started the rally. We ran above this short-term high here, and in the lower time frame, you'll remember that I had a fair value gap outlined. And then if we go through that, we want to see it trade above to this high here. Okay, and that's where the buy side liquidity pool was for the euro dollar. As you can see here, it has delivered in gangbusters. It's a beautiful delivery of price, and this is the type of thing you want to see. You want to find these things on your own, but every week I give you my opinion about where it's going. You can see this occurring on every time frame, so you want to be practicing it with previous days highs and lows, just the same way I've outlined it on the daily chart using the price structure that's here on the last, Wednesday's video. I said we would look for this here, and the previous two videos where I talked about this low being taken out and then rallied up. So what I did was I outlined the mechanism I had belief in, that IPTA would go below this low to allow orders to be broken to the sell side liquidity. So all that liquidity that was in here, for anyone that was long, they have stop losses below here. You're asking yourself right now, who would keep a stop loss down there once it's gone up to here? Large funds do that. Remember, the market's not trading against your forex.com account. Okay, the market's not going against your OANDA stop. Okay, you're just putting a stop where everyone's been trained to put a stop. The market's going to where the large fund stops are. Okay, and the easiest way to prove that to yourself is simply look at a net trader position chart and look at the large specs versus the commercials. Okay, and everything that they're doing is diametrically opposed perfectly. It's 100% diametrically opposed. The large speculators and the commercials are never doing the same thing, because the commercials are providing the liquidity for the large funds to work. That's what I go in looking for. Where is the large fund liquidity? Well, that's without me saying so, but I'm telling you now because it's the point of teaching it. But I told you what was going to likely happen, and I said, in a narrative basis, I said that if I was the market maker for euro, I would take the market down below this low here, upset everyone on the retail level, that a descending triangle would be validated if this low is taken out. And the function really that was going on is the sell side liquidity was being attacked. So all the market participants in here have a gluttony of sell side delivery to be coupled with their willing buying. So in other words, if you're bullish, this was like a smorgasbord, okay, and all you can eat for getting long, with the expectation that the orders down here, these sell orders that were being attacked, they were being purged. Smart money would be buying those sell stops. They're taking the other side of that marketplace. And then because now they're long, what do they want to do? They want to sell at a higher price. So using the market efficiency paradigm that I use in my teachings, where does that reside? Above this short-term high here, and then above this short-term high. So this is your dealing range. Okay, this high and this low. The understanding was we were going to use external range liquidity, which would reside below this low, and you'll learn all this in the mentorship. We want to use external range liquidity here to pair up to go long and trade to two levels of liquidity. Internal range liquidity here, because it's inside this high to the low that was formed. So we have internal range liquidity above the short-term high, and then external range liquidity here. Now, it's probably causing all kinds of things that start swirling in your head. What is this? What is internal range, external range? It's taught in the mentorship, okay? It's not imperative for you to know every single thing in the commentaries. It's little kind of like bullet points that will prompt you to go to your study journal and write down what is external range liquidity and how do you use it? What is internal range liquidity and how do you use it? That's what you should be doing instead of sending me an email after this video about what is this, and trust the process. It's taught. Believe me, it's taught. but you can't rush it. There's other things that have to go along in the order of your learning in the core content. But the idea is you're going to take orders that you buy at a lower price and you pair it up with people that want to buy at a higher price. Why is there buy side liquidity above this short-term high? Because remember, the market was up at this point here and traded down below this low. There are short traders in here. Their stop is now above this high. So when I go in and I'm teaching my students to go into the marketplace, we are looking for victims. Okay? We're looking for unlearned victims, just complete oblivious to what the mechanisms are in the marketplace that facilitate trade. I'm not looking at patterns. I'm looking at orders that reside and the underlying narrative that's in play at the time. So when I say other people in the industry are looking at candlesticks, patterns, indicators, and all that stuff, I'm looking for the things that don't exist in the chart. What am I talking about? I'm talking about the narrative, which I outlined before it happened here, and I'm revisiting it with greater detail now. And I'm looking for the liquidity that will be in that narrative. And that's all I just did here. Okay. So I'm not looking at candlesticks, order blocks, wicks, patterns. I'm looking at how other people would use those things and what they're thinking. So I'm reading their mind with the same chart that they're seeing. I'm able to look at that and say, okay, it's like a two-way mirror. When they're looking at the mirror, they just see their own reflection of what they want to see. I'm on the other side of that reflection without them knowing it, and I can see everything they're doing when they're crinkling their nose and making that snide remark, or they're showing what they believe is their best side. The mirror is lying to them because it's not really their best side. It's showing them an image that people that are looking at them, they don't see that. It's the opposite. And a lot of people don't realize that. If you look in the mirror, you're not seeing what everybody else sees. You're seeing the opposite of that. Well, the same thing at this chart. When you're looking at that chart as a retail trader, you're believing and seeing whatever you think is there. And I'm looking at it from the other side. You don't know I'm there. And I'm looking at it totally different. And I'm finding all of your weaknesses. So it's like looking at the people before they put their 30 different selfies they've gone through. Now they found one that they like and they applied 17 different filters on it with Snapchat. Then they'll put that online. And you meet them in person, like, who is that? And I'm not trying to be making funny. I'm not trying to body shame anyone, because believe me, I'm not a young man anymore. But the point is this. When we use charts here, we're looking for it to show us the weaknesses and the frailties of other traders. And that's the market efficiency paradigm. What you think you're seeing as a retail trader, I'm using that as against you as a weapon. And I'm looking for that narrative to be in play at any given time in the marketplace to facilitate a trade idea that I feel comfortable with. And then I will participate in, because it's likely to occur, because it's going to upset the obvious retail view that generally doesn't work. Okay. When retail theory is so clearly evident in the chart, it's almost like a 90% likelihood that's not going to happen. And that's why 90% of traders fail, because they see these patterns and it's like, oh, it's just like that book says. Oh, it's that inverted head and shoulders. Oh, it's that double bottom. Well, all that right away, when I said those things, the people that have been here for a long time or charter members, they're like smiling. Yeah, we like to see that stuff, because we know what we can do in that environment. And if you're a new student here, this just sounds like, okay, this is a whole lot of mumbo jumbo. Trust me, okay? There are things that you're going to see here that are going to challenge your treasured, most loved things, because you picked up something from another educator or another author or something you think you've discovered, okay? And I'm going to say something that's true, that's absolutely true. I can prove it every single day and every single week, and it's usable. It repeats. But it's going to challenge and upset you, and you're going to take it as a personal attack. That's where the people suffer here, because I'm going to offend everyone given enough time. If you stay here long enough, I am going to get that one button, or many of them, and I'm going to push it. and it's going to just drive you nuts. And you're not going to want to listen to me. And then when you try to do what you like to do, when it comes up, and then my theory will unravel right before your eyes, and your thing will fail. And then what'll happen is you have a choice. Wow, what he showed me was true. Or I'm a jerk, and then you're going to start attacking me or having feelings against me, and it will create a barrier in your learning. And that's what was going on over at Baby Pips. That's why it became toxic. And I challenged them more with it, because I need the people that are going to listen to me to really be invested in themselves, not in me, because I don't care ultimately who stays here. I don't. The people that stay, I care about those individuals. And it's not because of the money, because once you pay, you're a charter member, I don't get anything else out of you. It's it. You're a freeloader then. You're in here for nothing. Okay, so just know that there's a price that needs to be paid here, and it's not just those payments, because I'm going to challenge the way of thinking that you have. And for some that are weak-minded, it's going to be offensive to the degree that they're not going to want to listen to me ever again. And that's detrimental to the development. And unfortunately, that's just the way it is here. Because if you are going to be adversarial and not allow good medicine, good wisdom, good insight to take root in your understanding, then it's not my fault, it's yours. And that takes a great deal of responsibility. And a lot of times, many times, students in here have been met with that wall, and they have to make the choice and say, okay, it's uncomfortable, I don't like how it feels, but I'm going to trust what he says and just take that as this is the way I should be thinking about it. And if you are flexible when it comes to those moments and rigid in the rules when I give them to you, you're going to do extremely well. And you're going to get there faster than you thought you were going to get there. But the pitfalls are always the ones that are met with the psychological barriers that I, on purpose, present throughout this mentorship. And I'm going to say something that's going to be offensive. I'm going to say something that's going to attack a different trade theory that maybe you like. Maybe you even made money with it. But I'm going to show you its flaws and how I use that very thing to go against people that think like that. And it's 100% diametrically opposed. And my stuff will hold up longer than all these other theories. I've already been through all that stuff. Okay, I've already been through it. And I can tell you, I don't regret leaving it. And I wish I would have been able to leave it sooner. But just like you, I was human. I believed what I believed, and nobody was going to convince me otherwise, and blah, blah, blah. And the whole time I was losing money and blowing accounts because I knew it was going to work for me. And then I could say, ha, you were wrong. And then when I realized that all that stuff is stupid, I was doing stupidity over and over and over again. Okay. And I was Moron Incorporated. Nobody could talk to me. No one could reach me until I just simply couldn't do it anymore. When I started looking at what I was doing and failing, and then I understood how the markets actually worked, then and only then I said, okay, I'm going to attack my own analysis. I'm going to see where, if I'm wrong, how is this trade going to fail? And why would that other side of the trade work out better? And that was uncomfortable. That was really uncomfortable. And for years, I thought I was developing a split personality because I was nuts about it. Like, I literally held for 2 years 2 journals that were basically diametrically opposed. One journal, I would say, this is what I'm seeing for this. And the other journal, I'd say, okay, this is what I'm seeing, this. And then I literally would compare and contrast that. And then I could see the character flaws I had. That takes a whole lot of work, a great deal of work. But that's how I figured out my problems. But that also taught me, without me realizing as a default and byproduct, is that I could see the two-way mirror of retail. They're looking at the mirror. They think they look good. I mean, I got a winning trade. This is that bull flag. I bought this trend line right at the right time. I got my order sitting right there. Boy, I'm going to make so much money. I'm seeing something totally different. And that's what was frustrating to people over baby pips, because they're like, how are you seeing that? How are you able to do that over and over and over again? I was wrong. I was going long and you went short. I did live sessions back then. One time, I did a live session one time, and people watched me. I was in a market move. I was long, and I knew right away I was wrong. I got out and flipped it, went the other way. And one guy over there, I can't remember his name, but if I'm not mistaken, I think he ended up making it in the mentorship. And if you are the gentleman, just say, it was me, ICT. I don't remember who you are right by your name, but the guy was like, how did you know? That was incredible. Like, you knew right when it was going to reverse and then went the other direction. That's experience. And I saw something right away that retail would have been feeling good about. And I knew right then and there, I'm wrong. I have to either get out or reverse. And it's not always a reverse. Sometimes it's to get out and just be content with the get out, either with a loss or whatever you got. But when we're looking at charts, okay, the commentaries is the mentorship. It's the time here. I mean, all these videos, all of them, are just little tiny little pieces, because you're getting segments of my time and my perspective. That is mentorship. Being here every single week and understanding what the market's likely to do, and then when we watch it, we study it, and I go and I show subtle nuances, that is mentorship. Like, for instance, if I stopped right now and never did any other videos, it's incomplete. It's incomplete because you haven't been shown how all these things fit together. Now, you have all the pieces, and I've told you how to put things together. The models and the trade plans are how one interpretation, or in this case, 12 interpretations, could be used to make a trading plan from a model, from all the content. But they're not limited to those 12. And that trading model, with that trading plan, I could literally load it to YouTube and it's going to be useless. There's going to be people out there that, on Instagram and Twitter, oh yeah, I got it figured out. This is the so-and-so. And it'll always be hindsight. They won't ever be able to do it live. They won't ever be able to tell you what's going to happen next. That's what's going on with my stuff. Nobody out there has the whole thing. Nobody has the mentorship. No one has graduated. No one is, hitting it on all cylinders that started with me in 2016. Okay. That has not happened. Now, I have people that have reported to me that they have quit work, that they are profitable, they have done exceedingly well, but there are people that still report, even from the 2016 group, that they haven't found their way yet and they're still struggling. So don't think that it's just a master recipe for everyone to come in here and it becomes just, money falling out of the sky. It's not what this is. It's a lot of work. And you're going to find that you are that barrier to it. And yes, I'm giving you a whole lot of jawboning, aren't I? See that? Whenever I say it's going to be a short video, if I'm trying to go through it quickly, it's possible. Just stop the video, go get something to eat and drink, because we're going to be for a road trip. But this is good stuff. Okay, it's really good stuff. And I wish I had someone that was able to sit down with me and say, these are the things I went through, and this is how I learned to get through it better. And it turned the corner in my development. I didn't have that. And I waffled for 6 years. I thought I had it, and then I'd lose it. I thought I had it, and I'd lose it. And by going back and seeing the things that was working and removing all the things that didn't work, and the only way I could have done that is by journaling. Okay? Really focusing in on the things that I was doing right, that were consistently right, and then seeing what I was doing with those two journals. One perspective, I could see the market being bullish because of this, and this is how I trade it. And then say, okay, I am the other guy that's smarter. And I didn't have a book that was, this was the smart guy and this was the short guy. The stupid guy. It was the idea of looking at both of them in a contrasting perception of how both views for individual case studies every single day, what was right about the side that was right and what was wrong about the side that was wrong. And by doing that, and it might be an exercise that would be fruitful to you. It may be too much work for some of you. Okay. I'm just telling you how I personally did it. That's what I did. And right at the end of that 6-year mark was the end of the 2 year of 2 journals. And it really exposed all of my personal failures, my frailties, my weaknesses, and I didn't like how it felt. I didn't like it. I mean, it made me second guess myself as a man. It made me second guess myself as potentially successful, and many times question whether I was ever going to be successful. And that's normal. That's normal. You're going to feel that. You're going to feel that through this entire mentorship. Even when you become a charter member, you're still going to feel that. That's all normal. That's a normal feeling because it's a growth pain. When you were growing as a child, you went through growth pains. Your feet hurt, your legs hurt. It's normal. But at the time going through it, you hate it. It sucks. You want to be anywhere else besides that place, that moment in time. But in trading, as a developing student, you want to really dig into those moments because that's where your treasure lies. All of that adversity, all of that stuff that feels uncomfortable while you're learning, they are the very opportunities that the enemy is hiding the biggest jumps in your understanding and insight. If you just would spend more time in that moment of what causes that hardship, learn from that and don't be afraid of it. Because if you dig into those moments and see why you failed, you're not in there to beat yourself up. And in those 2 journals, I did not say, man, I got it wrong, I suck. Both sides, both journals of the view of the marketplace for the S&P and the bond, this is what I was doing it with. I would contrast both, but just on the basis of this is what I believe, this is what should happen. Done. The other side, this is what I believe, this is what should happen. Done. So I had reasons to justify my view on both journals, but those journal entries were always opposed intentionally. But the first journal entry was always, what do I feel looking at the chart that I would put money behind? Then the second journal entry, and it wasn't always me reaching for the same one that was opposing. Okay, it wasn't like this was the evil market maker journal view and this was the retail rookie. It wasn't like that. Okay, it was just 2 journals running side by side. One had an opposing view, and I would always go in and give the opposing view. That's why I taught a couple weeks ago, or maybe it was last week. I don't know. Can't remember exactly when it was now. I taught you the secret to high probability, because if you can only justify the idea of it going higher with my concepts and not at all going short, you have a high probability trade, or vice versa. So you don't want to be able to outline a ICT setup on both sides of the marketplace, because if you can do that, it's a low probability setup. If it's very, very clear, it's going higher and you can't justify it going short with any of my concepts or the things that I teach, then, it gives you a way of measuring. And it's not just simply because it's always commonly tossed around, just like institutional trading is now, like it's some freaking secret thing. High probability is defined by understanding the lack of high probability. Like you have to really understand it intimately. What makes a scenario low probability? And none of the books out there have topics like that. They don't write books. Here's a book with only low probability setups. Who's buying that book? I would. But 99% of you wouldn't. Because low probability is what you think you're trying to avoid. But understanding low probability setups was basically all of retail universe theory. Because that's what that is. It's all low probability. It's low probability with low experience, low aptitude, and low money management. So is it any question why most people fail? Of course, it's a given. It's absolutely...